Good morning, almost afternoon to all of you. Thank you so much for joining us today. It's just delightful to see everyone here. As mentioned, I'm Gina Martin Adams. I'm the Chief Equity Strategist of Bloomberg Intelligence. Bloomberg Intelligence is the research division of Bloomberg. For those of you who are not familiar, we have 275 analysts covering 135 different industries, 1,900 equities and 300 credits, as well as macro strategy, government policy, and litigation across the world. BI go on your terminal. But that aside, I'm here as an equity strategist today to talk to you about investing in a sheep. What is a sheep? What we find is the US equity market is no longer in a very strong bull charge. It's no longer in a very strong bearish retreat either. Instead, it's behaving much like a sheep. It's sort of ambling along, making its way forward, prodded and shepherded by better earnings environment, but certainly prone to flight risk, certainly prone to bouts of volatility, certainly prone to insecurity as a result of evolving policy risks. So how do you make money in a sheep type of market? Certainly not as easy as the 2017 market was, where just everything went higher. It's a different type of market, so I'm going to leave you with 3 strategies to make money in a sheep. First, I want to talk about the broader macro landscape. How do we get to this analogy? How do we decide that the market's in a sheep? Well, we run a regime model. We run a model to determine where we are in the economic cycle as well as where we are in the market cycle. And we find that a combination of multiple economic factors and multiple market factors suggests we're in the later stages of a market advance. It doesn't mean that the turnover is imminent. It doesn't mean the bear market is imminent, but we are in the later stages of a market advance. Combine that with the expansion phase of the economic cycle, and you come up with some consistent characteristics. You come up with a market that is likely to continue to advance, but at a slower average monthly pace than was exhibited in recent years. You're likely to see bouts of volatility. As volatility remains generally low, the VIX today is at 12. It's still very low, but we have had a few volatility spikes this year, unlike last year. You're likely to see correlations across the market remain relatively low. It is still a stock picker's market as a general rule. And you're likely to still see cyclical sectors outperform in an environment of accelerating earnings growth. But how do you pick those winners? What are the winners in a market that looks like a sheep? Let's talk about 3. The first is leverage. You want to avoid the most highly levered companies in the S&P 500. What we're showing on the screen here is the pure leverage portfolio designed by Bloomberg, plotted against the yield curve. And what you find over time is as the yield curve moves, so moves the pure leverage portfolio. When the yield curve is flattening and the Fed is increasing interest rates, tightening borrowing conditions, increasing the cost of debt, you find that the most highly levered companies in the index pretty dramatically underperform those with lower leverage. Indeed, that's been the case for the better part of 3 years, but you can see an acceleration in recent years. As a matter of fact, the companies with the highest debt to EBITDA in the index over the last year have underperformed companies with the lowest debt to EBITDA in the index by 1,400 basis points. So this simple strategy would have provided you with a pretty significant return in the market, and we think this is going to continue going forward with the Fed likely to produce another 2 or 3 interest rate hikes this year. A second strategy for performance in a sheep-type market is to really gear your portfolios to the companies with the highest profitability in the index. Why profitability? We actually find that over time, in an environment where VIX is starting to rise, profitability as a factor performs best. So the companies with the highest ROE, the highest return on invested capital, highest ROA, and highest margins in the index tend to outperform the companies with the opposite. This particular graph shows you how vast outperformance profitability has provided as a factor relative to other factors in periods in which the VIX is rising. Third thing I'd like to talk about is sector strategy. I mentioned that in a sheep market, despite the fact that the market is starting to move a little bit higher and it's not moving at a very robust pace, you want to gear portfolios towards cyclical industries. I have here our sector scorecard. This actually operates completely independently of the regime model. takes a composite of 5 different factors for performance for the sectors of the S&P 500. We combine price momentum with price breadth, earnings trend with earnings breadth, and valuations, put them into a large model and determine what sectors are best positioned to outperform over the next 6 to 12 months. And you can see generally the cyclical sectors are much better positioned than the defensive sectors in the index. So now is not the time to rotate defensively, considering all the evolving policy risks. Instead, you want to be fairly selective but stay in cyclically oriented sectors. The sectors that fall at the top of our scorecard right now are energy, technology, materials. So very late stage sort of market sectors tend to be preferred. Now, what's interesting about this is when you look across the opportunities at the sector level, not all stocks within every sector are created equally. We have a great tool on the Bloomberg terminal called FTW, Factors to Watch, and it gives us a sense of within each sector what factors really matter for performance. So if we take the S&P 500, we look at the tech sector within the S&P 500, what has really been most meaningful to drive performance over the last year, last 3 years, last 5 years, and you could see earnings revisions are most meaningful. In fact, over the entire cycle, revisions and sentiment drive tech. So if you're using a model that heavily relies on valuation for performance, you're going to miss the boat. You want to really focus on tech, within the tech sector, on the stocks that are producing the fastest earnings revision, momentum over time to outperform. This is very much the same. Energy has different characteristics than financials, which has different characteristics than materials and the like. So 3 things to invest in a sheep market. You want to focus on leverage, focus on the lower debt companies relative to the higher debt companies. You want to focus on profitability, high ROE, high ROA, companies with higher margins. And you want to focus on cyclical companies, in particular in the tech and energy sector, if our scorecard is correct. As you've seen here, my page on the terminal is BI Stocks, BI space STOX. You can get all of the research on BI Go if you're interested in more detail, but BI Stocks covers the equity strategy. My team is available to you at any time. We also have a number of ways you can participate in hearing about the market outlook. We have a macro call every Monday. We have a webinar monthly in collaboration with the rest of the strategists. We collaborate with the entirety of the BI team. So I would urge you to take a look at BI Stocks or BI Go, and I'll leave you with that to discuss the broader macro outlook. Thank you.